Let me ask you something, and I want you to think carefully before you answer. You did everything right. You didn't trust paper. You didn't trust promises. You walked into a dealer, handed over real money, and walked out with something solid, something real, something that has held value for thousands of years. You own physical gold bars, and for a while, that felt like the smartest thing you'd ever done. So why is it that right now, in this exact moment, there are things happening in the gold market that every physical gold bar owner absolutely needs to understand? And almost none of them do? I'm going to tell you what's actually going on. Not the watered-down version you'll see in a headline, not the feel-good summary that skips the hard parts. I'm going to walk you through what has changed, what it means for the bars you're holding right now, and most importantly, what you need to do about it, because there's a difference between owning gold and owning gold strategically. And in the environment we're in today, that difference could be worth more than you realize. Let's start with the price, because it sets the stage for everything else we're going to talk about. Gold is trading above $4,500 an ounce right now. Let that sink in. Silver is pushing above $75 an ounce. These are not small numbers. These are not speculative bubbles. These price levels are backed by real demand, real institutional buying, real geopolitical shifts. And the major banks, Goldman Sachs, J.P. Morgan, are projecting prices could push into $5,000, even $6,000 territory before this cycle is done. So, if you're sitting on physical gold bars, at one level, you should feel vindicated. You should feel like you made a very smart call. But here's the thing, and this is the part that doesn't make it into the headlines. Owning gold bars at these price levels comes with a completely different set of considerations than it did when gold was $2,000 an ounce or even $3,000. The rules are changing. The systems that track, verify, and regulate physical gold are evolving in real time. And if you're not paying attention, you could find yourself on the wrong side of a shift that you never even saw coming. Before I get into all of that, let me just say quickly, if you're watching this and you're serious about protecting what you've built, I put together a free guide that walks through the saving strategies that thousands of American retirees are using right now to protect their hard-earned wealth. It's linked in the description below. Go check it out. It won't cost you anything, and it might reframe the way you're thinking about your entire strategy. Now back to what's actually happening. The London Bullion Market Association, the LBMA, which is essentially the backbone of the global physical gold market, has launched a new reporting initiative called the Gold Bar Integrity Database. This is not a rumor. This is not speculation. This is a real active system that is now tracking good delivery gold bars at a level of granularity the market has never seen before. The initiative requires major refiners to report country of origin data for the gold they produce, and the language coming out of the LBMA makes it very clear that what starts as voluntary today is heading toward mandatory monthly reporting tomorrow. Why does this matter to you? Because every good delivery bar has a serial number. Every good delivery bar has a stamp, a refiner mark, a chain of custody. And as this database fills out, the gold market is moving toward a world where the history of your physical bar is visible, traceable, and verifiable in ways it simply wasn't before. For some gold bar owners, this is a non-issue. For others, depending on where their bars came from, when they were purchased, and how they've been stored, This could raise questions that weren't on anyone's radar a few years ago. Now, I want to be clear. I am not suggesting that owning gold bars is problematic. Quite the opposite. What I'm saying is that the market is professionalizing at a rapid pace, and the gold bars that are most liquid, most valuable, and most easily transacted are increasingly going to be the ones with clean, verifiable provenance. And if you're holding bars that have any ambiguity around their history, now is the time to understand what that means for your position. Let me give you some context here, because this connects to something much bigger. The reason the LBMA is doing this, the reason there is suddenly this enormous global push for transparency in the physical gold market, is because the physical gold market is getting crowded. And when I say crowded, I mean institutions are piling into physical metal at a pace that is genuinely historic. Central banks bought over 700 tons of gold last year. 700 tons. And the projections for this year are tracking at a similar pace. Now think about what it means when the institutions responsible for managing national wealth, the people who literally decide what money is worth, are moving into physical gold at that kind of volume. These are not momentum traders. These are not retail speculators chasing a chart pattern. These are entities that operate on decade-long time frames. They are telling you, through their actions, that something fundamental has shifted. And what has shifted is their confidence in the U.S. dollar as the world's reserve currency. I know that sounds like a dramatic statement. I know it sounds like something that belongs on a newsletter with a lot of bold font and exclamation points. But bear with me, because the numbers tell the story better than any headline. The de-dollarization trend, the slow, deliberate move by countries around the world to conduct trade in currencies other than the dollar, has accelerated in a way that most American investors haven't really internalized yet. The BRICS nations, which now represent a substantial share of global economic output and population, have been systematically reducing their dependence on the dollar-based financial system. They are settling more trade in local currencies. They are holding more gold. They are building financial infrastructure that does not route through New York or Washington. This is not conspiracy theory. This is trade data. This is currency reserve data. This is something you can look up. And what it means for physical gold is that the asset is no longer just a hedge against inflation for American retirees, though it absolutely is that. It has become a geopolitical asset, a stateless form of money that exists outside of any single nation's ability to devalue, sanction, or freeze. And when you understand gold through that lens, the price levels we're seeing today start to look less like a speculative rally and more like a fundamental repricing. Let me take you back to the 1970s for a moment, because history has a lot to teach us here. After Nixon ended the dollar's convertibility into gold in 1971, the price of gold went through a decade-long explosion that most people today can barely comprehend in percentage terms. In the years that followed, gold went from being artificially suppressed to finding its true market value, and it ran from under $50 an ounce to over $800 an ounce by 1980. That is a move of more than 1,500% in less than a decade. Now, here's what's interesting. In that same period, the people who did best were not the people who simply owned gold. The people who did best were the people who understood the structure of their position. They knew exactly what they held, how it was stored, how it was titled, and what it would take to convert their physical metal into liquidity at a moment of their choosing. The people who got tripped up were the ones who were reactive rather than proactive, who didn't look at the bigger picture until the moment of maximum urgency was already on top of them. Sound familiar? Because that's where we are again. There's another dynamic at work right now that is getting almost no coverage in the mainstream financial press, and it directly affects people who own physical gold bars. It's the tension between the paper gold market and the physical gold market. For decades, the COMEX, the commodity exchange in New York where gold futures are traded, has operated with a ratio of paper contracts to physical gold that made some analysts deeply uncomfortable. The basic mechanic is this: far more paper claims on gold exist than there is actual physical gold to back them up. This worked fine when gold was primarily a financial instrument traded by institutions using it as a price hedge. But when the market shifts, and it is shifting right now, from treating gold as a financial instrument to treating gold as actual money, as something to be physically delivered and held rather than financially settled, the system comes under enormous stress. We have seen periods recently where COMEX inventories were being drawn down at rates that raised serious questions about the exchange's ability to deliver physical metal. We have seen premiums on physical gold spike well above spot price, reflecting genuine scarcity in the physical market, even when the paper market told a different story. What this means for you as a physical gold bar owner is that you are holding something that is becoming more valuable relative to the paper contracts that track the gold price. You are, in a very real sense, ahead of the curve. But again, this comes back to structure. The value of your position depends on your ability to actually realize that value when you choose to, or when you need to. Now, I want to pause here for just a moment, because I know some of you watching this are thinking about your broader financial picture. You're thinking about retirement. You're thinking about whether the portfolio you've built, the 401k, the IRA, the investment accounts, is actually positioned to protect you through whatever comes next. And I want to tell you about something that a growing number of Americans in or near retirement have started doing to bridge the gap between their paper assets and the physical protection that gold provides. A gold IRA allows you to hold physical gold, actual bars and coins that meet IRS standards, inside a tax-advantaged retirement account, not paper gold, not an ETF. Physical metal held in an approved depository on your behalf. For people sitting on retirement accounts that they worked decades to build, this is a way to bring the protection of physical gold into the structure that gives you the most tax flexibility. If you have $100,000 or more in any retirement account, and you've been wondering whether gold belongs inside that structure, that's worth a serious conversation. The guide in the description covers how this works. Take a look, and then let's keep going, because I want to show you exactly what the data is telling us about where gold is headed from here. Let me talk about fundamentals for a moment, because this is where a lot of gold commentary goes shallow. People get excited about geopolitics or inflation, and they stop there. But the supply side of this market is doing something that doesn't get enough attention. The gold mining industry has been in a structural production squeeze for years. The easy, high-grade deposits have been mined. The new discoveries are deeper, harder to access, lower grade. The industry is not growing production at a pace that can match the demand being generated by central banks, ETFs, and retail investors simultaneously, when you have a supply side that is essentially flat and a demand side that is accelerating, the price mathematics are pretty straightforward. Goldman Sachs has put a target out there that most people don't believe when they first hear it. J.P. Morgan has a number that sounds even more aggressive. These are not fringe analysts. These are the people who manage trillions of dollars of institutional capital. When they put those numbers out publicly, it changes the behavior of other institutions. It becomes a self-reinforcing signal that draws more capital into the market, which supports the price, which validates the thesis. And then there's the currency side of this equation. The purchasing power of the dollar has been eroded by monetary policy decisions that were made in the wake of every major financial crisis over the past 2 decades. The Federal Reserve expanded its balance sheet. The Treasury issued more debt. The mechanisms designed to maintain the purchasing power of savings have not kept pace with the actual cost of living for ordinary Americans, and especially not for retirees on fixed incomes. Gold, over any meaningful period of time, has maintained its purchasing power through those episodes. An ounce of gold bought a quality set of clothes in ancient Rome. It bought a quality set of clothes in 1970. And it buys a quality set of clothes today. That is not a coincidence. That is the nature of what gold is. For someone who has already done the work of acquiring physical gold bars, this is validation. But it also brings a question that I think deserves a direct answer. What do you actually do right now? What are the specific moves that someone in your position should be thinking about? First, understand your bars. Know the hallmarks. Know the refiner. Know the serial numbers if you have them. As the Gold Bar Integrity Database and similar tracking systems become more standard, having documentation that establishes the provenance of your metal is increasingly going to matter for liquidity and premium. A bar from a well-known, internationally recognized refiner with clear documentation is going to command better terms in a transaction than one with ambiguous history. Second, think about storage structure. As the value of physical gold climbs, the logistics and security of storage become more meaningful. Many people who bought gold when it was a fraction of today's price set up storage arrangements that made sense at the time, but may need to be revisited given current valuations. Insurance, access, and counterparty risk in your storage arrangement all deserve a look. Third, and this is the one that catches people off guard, think about the taxable event. When you do decide to sell or convert your physical gold bars, you're going to be dealing with capital gains treatment that at these price levels can be quite significant. If your bars have appreciated substantially, the after-tax proceeds look different from the gross value. There are structures, including certain IRA arrangements, that give you ways to manage that exposure, but they require planning ahead. They are not something you can bolt on after the fact at the moment you decide to liquidate. There is also a conversation happening at the institutional level that is going to reach the retail market eventually. It's a conversation about what digital infrastructure for physical gold ownership looks like. The LBMA's tracking database is one piece of that. There are discussions in the broader market about tokenized gold representations, about blockchain-based chains of custody, about ways to make physical gold more liquid and more transactable without sacrificing its essential character as a physical outside-the-system asset. Where exactly that goes is an open question. But the direction is clear. Physical gold is being professionalized, digitized in its documentation layer, and integrated into the global financial infrastructure in new ways. For owners of physical bars, understanding which direction those developments go and how they affect your specific position is part of actively managing your wealth, rather than simply holding it. Let me bring the historical lens back here because I think it's instructive. In 1980, gold hit its then all-time high and then pulled back dramatically over the next 2 decades. A lot of people who had held physical gold through the 70s bull run ended up giving back enormous amounts of the gains because they didn't manage the second half of the cycle as well as they managed the first. They bought early and held patiently, which was right. But when the inflection point came, they either sold too early, held too long, or didn't have the structural flexibility to optimize the exit. The people who came out of that cycle with their wealth truly protected were the ones who had thought through not just the thesis for owning gold, but the complete picture. Where it was held, how it was titled, what the tax treatment would look like, and how it fit into their broader financial plan. The same principle applies today. The thesis for owning gold is as strong as it has ever been. The macroeconomic backdrop, debt levels, currency debasement, geopolitical instability, de-dollarization, is arguably more compelling than anything we saw in the 1970s. But having a strong thesis and having a well-structured position are two different things, and the gap between those two things is exactly what this video's about. The urgency in the title is real, not manufactured. The change is happening right now at the LBMA, in the COMEX, in the way central banks and institutions are positioning, in the regulatory frameworks that govern physical precious metals. These are not slow-moving changes. They are accelerating. And the window to get ahead of them, to make deliberate, proactive decisions rather than reactive ones, is not infinite. The people who are going to look back on this period with satisfaction are the ones who used the time they had to understand their position fully, who asked the right questions about their bars, their storage, their tax exposure, their liquidity options, and their broader retirement strategy, who didn't assume that because they had taken the first step, acquiring physical gold, the job was done. Owning gold bars is one of the smartest financial decisions a person can make in an environment like this one. The data supports it. The institutions are validating it with their capital. The history confirms it. But owning gold strategically, understanding what you have, how it fits into the total picture, and what moves you need to make to protect and optimize it, that is the level where real wealth is preserved across generations. I said at the start of this video that I wanted to show you what's really happening. And what's really happening is a confluence of forces. A new gold bar tracking infrastructure rolling out globally, institutional demand at record levels, central banks front-running a dollar regime shift, a paper gold market under structural stress, and a macroeconomic backdrop that almost universally favors hard assets, that is creating both enormous opportunity and genuine risk for people who aren't paying close attention. The opportunity is that gold at these levels, with the institutional tailwinds behind it, could continue its trajectory in a way that permanently changes the wealth equation for people who are properly positioned. The risk is that the complexity of this moment, the regulatory changes, the storage considerations, the tax implications, the provenance documentation requirements, could trip up people who are holding physical gold but haven't thought through the full picture. If you watch this whole video, I want you to know that means something to me. It tells me you're serious. You're not here for the 30-second take. You want to actually understand what's going on. And so, I want to give you something specific. For those of you who are American retirees with $100,000 or more in any retirement account, whether that's a 401k, an IRA, or anything else, we've set aside a limited number of spots for an exclusive one-on-one educational web conference. No obligation, no sales pressure, just a real conversation with someone who can look at your specific situation, your gold holdings, your retirement accounts, your overall picture, and give you an honest assessment of how to think about the decisions in front of you. All you have to do is mention this video when you reach out through the link in the description. The free guide is there for everyone. The one-on-one session is for people who are ready to have a serious conversation. Either way, the link is in the description. The time to act strategically is before the urgency becomes unavoidable. That's always how it works. The people who plan ahead don't have to scramble. Take the step. Check the description. And if you're serious about protecting what you've built, I'll see you there.